Well, joining me now to talk more about these markets amid some very busy overnight action, including, at least a temporary trade deal between the U.S. and China, is Thomas Hayes. He's a chair and managing member at Great Hill Capital. Thomas, always great to have you on the show. I think last time you joined us, you were pretty bullish, and since then we've seen the S&P 500 rise. What do you make of this deal and where it puts us for equities?
This is a landmark deal. This is a landmark morning. Particularly, here's the phrase of the day: trapped bears. Okay, we had record selling. $1.1 trillion was sold at the absolute lows in early April by hedge funds and CTAs. Now they're forced to cover, they're forced buyers, they're forced to chase up. You couple that with record amounts of buyback announcements, $665 billion of buybacks announced. These guys are in trouble, okay? Let's just put it that way as they chase up. So I think we're gonna get some follow through for the next few days. Once everyone gets in the boat 3-4 days from now, we probably start to get a little bit of consolidation, a little bit of pullback for the Johnny-come-latelys. That's just the way it always works.
Yeah. So what does this tell us? Has it been a change in true direction, or is this still a very dynamic trading market?
Yeah, it's interesting. I look at earnings, and earnings in the face of all of this uncertainty and all the, let's be candid, chaos that was going on for a couple of months, came in so much better than expected. 13.4% versus 6% estimated, with 90% recorded. Then you look at the guidance, estimates didn't come down that much. They came down from 270 to 265, 3.6% reduction, but 2026 held up at $300, which means we're only trading at 18.5 times compared to 18.3 times for the last 10-year average. So there's a lot to do. I think you got to really start to look at the things that were hit hardest by tariffs are going to be the greatest recovery opportunities.
And already we're seeing some of these semiconductors, technology names, riskier stocks, ones with a higher beta, certainly ones that sold up dramatically. I think the semiconductor index at one point was down 40% in that April 2nd announcement. Those seem to be the ones coming back the most. Is that what you see?
I think so. The other thing I'm looking at is cyclicals relative to defensives is at a record all-time low positioning. So cyclicals, we start to look at consumer discretionary, we start to look at industrials, we start to look at materials. Maybe you even start to look a little bit over at energy, because you noted this morning that the S&P was up a certain percent, the Dow was up a certain percent. You know, it was up more than all of them? Russell Small Cap Index, largest short interest on record. So if the game is on, is really what it comes down to. And I think you'll see it in the indices for sure. But there are so many stocks that are still down 50%, 60%, 70% that are great businesses that have been around for decades that are going to start to fly.
Interesting. Other particular stocks on your radar?
Yeah. Disney, we came out publicly like 3-4 weeks ago. It was a no-brainer. We said, buy Disney at $85. Of course, the next few days it went down to like $82 because that's what always happens. But now it's at $108. It's going to continue to climb over the next 2 years, probably over 200 in our view. All of their segments are growing at mid-teens, double digits. They just put guidance out for $17 billion of cash from operations this year. So this is a well-run business. 180 million streaming subscribers. They grew 2.5 million. So there's a lot of good things happening there. They'll continue to invest. We saw the park in Abu Dhabi. They'll continue to invest in the cruise ships, which have a very high return on invested capital, like mid-20s return on invested capital. So that business is going to continue to grow. And then the second one I have, no one is going to buy when I put out this name. They're all going to say this guy's crazy, and then a year from now we're going to be back on and be like, do you remember last year? It's called Albemarle. It's the #1 lithium producer. Positioning for materials. Materials is going to have the highest earnings growth, second highest earnings growth in 2026. You're getting positioned ahead of time. Lithium is in a glut. Everyone thinks EVs are done, except for the fact the US is 10% of the market. China is 60% of the market. It's not a natural market. It is a subsidized market. It is policy initiative. They grew EV sales 38% last month. Albemarle's lowest cost producer. They've got these mines in Chile, and they've got $3.1 billion of liquidity to ride this out. So as all the smaller players go out of business, as prices are down, that shrinks supply. Albemarle is left standing, and the operating leverage is huge. This one, we talked about Disney going up, whatever it was, a double plus from this thing can go up a lot more than that over the next 3 to 5 years as the market. Demand for lithium from 1.2 million metric tons today to 3.2 just in 5 years. And so we're not looking at a triple because the operating leverage in that business could be a lot more than that. So that's a good one. It's a long-term one.
Yeah.
It's whatever, $61 today. I'm sure it'll go to 55 tomorrow. But a year from now, it's going to be a lot higher. I can tell you that right now.
And now, where's the demand coming from, Thomas? You see it around the world or specifically in China?
Predominantly China. Also, it is going to be around the world because it is a cyclical thing, but also energy storage is a big component to this. It's not just EVs. And as you need more and more of these devices and you need, the demand is unlimited for this. And the tariffs really hit it. The glut in the cycle really hit it. But you know what? If you look at the long-term chart, this happens every 3 to 5 years for Albemarle. It happens every 3 to 5 years for lithium. They have a few other businesses that'll support them through this.
Yeah.
But they'll be the last man standing, and they'll reap all the benefits as we recover.
You know, it's interesting. It's obvious, right, based on the market observations that we can see that the president is able to move the markets with his commentary and changes in policy. There's one other factor, though, and that's the Federal Reserve and how it decides to respond to these policy changes, as well as some of the economic data that we'll get this week. What does that mean for the markets? The fact that the latest indication from Jerome Powell is that he is going to take his time.
Yeah, it's interesting. I was thinking about that on the way down here. I was pretty certain we were going to have 2 cuts this year at the back half of the year. Moving forward, if this continues in the same vein, I think 1 cut, we're probably still going to wind up with 2 cuts because we'll get this initial high and then we're going to say, well, you know what, there was some short-term damage done to small businesses. It's going to take them a couple quarters to recover. So I think 1 to 2 is still a safe bet this year. I think Bessin's working on the long end of the curve, which is more important as it relates to housing, as it relates to refinancing the debt. So all in all, very sanguine here and pleased to see this. It did come a bit sooner than we expected, so we're not arguing about that. That's for sure.
All right, Thomas Hayes is a chair and managing member at Gray Hill Capital, joining me in studio on a very busy market day. Thank you so much, Thomas.
Thanks for having me, Kristen.